In this video tutorial, I'm going to spend a couple of minutes talking to you about some of the indicators that are in the standard indicator bundle. The standard indicator bundle is a compilation of indicators that we have developed over the years. We do not necessarily use these indicators every single day in the trade room, but this indicator bundle is important because as traders, we all see the world a little bit different based upon our particular personality types. And so if we all agree that the most important thing to do as a trader is to manage your reward to risk ratios, we can also all agree that not everybody sees the markets in the exact same way. And so to that end, there are breakout traders, there are fade traders, there are scalpers, there are people who like to trade the market in these different ways. But again, once we are all in a trade, we all should have the same basic concept and idea, which is to cut the losing trade short and let the winning trades run. And so this series of indicators have been developed over the course of time that we have been running the oil trading group. This is at the making of this video in early September 2018. We have been here for 8 years. And so I'm going to show you a few of these indicators here and just briefly explain how they work. The first indicator that you see on your chart is what we call a range trade. Now, the original use for this range trade was back on the CL before everything moved over to electronic trading. The regular trading hours or pit open was extremely volatile. And the concept behind this range trade was that you would take the first 5 1-minute bars leading into the open, and then that area would create a range like you see on this blue box here on the screen. And then at the top of the range, you would enter on a buy stop 2 ticks above, and you would enter on a sell stop 2 ticks below, depending on the direction of the breakout. Now, the pit open is no longer a thing anymore, right? We do have regular trading hours, but it doesn't move in the same volatile way that it used to. But that does not mean that there's not a use for this particular indicator. What you are seeing here on your chart is the bars leading into the crude oil inventory report on August 29, 2018. And you can see that blue box formed just ahead of the announcement. And so while I am not particularly a fan of trading around that announcement, there are people who are, and if you are one of those people, this is one of those indicators for you. And so again, you can see how the box formed around the 1-minute bars leading into the inventory number. You had a break 2 ticks above the top of the range. You had a breakout potential buy stop opportunity at 69.13, and the market rallied all the way up into 69.55. Now, if you were playing your support resistance levels, the market maker levels that we talked about in a previous video, let me put those on the chart here for you. And while I'm doing that, I'm not necessarily advocating that you take trades like this. I'm just showing you as an example of a tool that you can use if you are so inclined. And we're going to turn off the structure levels here for a minute, turn on these overnight levels. And you can see how that lines up nicely with some of the structure that you had in place here, right? So a breakout 2 ticks above the structure signal. We talked about kick the signal and pay the target, and the market rallies all the way up into that area right at the announcement. So again, I'm not advocating that as a strategy. I'm just simply showing you that the tool could be used in that way. Another tool that we like if you're a breakout trader, and again, a couple of these things that we just showed you were breakout trades, we have what we call the market trend indicator, right? And so basically the way that this indicator works is you have a moving average cloud. The market is trading in the direction of the moving average. Gives you a signal entry here at 66.02. And again, this is back on the 21st of August, 2018. The first 3 targets that you see here are the ones that are most likely to be achieved. The fourth target, fifth, sixth, and the fourth, fifth, and sixth targets all the way up to target number 7 are colored in red, and they are targets that are less likely to be achieved. In this case, market rallies all the way up into target number 4 from this, what is that entry, was 66.02 up to that target 4 at 66.47. That would be 45 ticks. So if you had a 10 tick stop, that would give you almost a 5-to-1 risk reward ratio. And so that gives you an idea, right? This allows you to get into sync with the trend. Well, that's why we call it the market trend indicator. It gives you that opportunity. You get the signal bar here, and then the market rallies up through in the direction of the current trend. So that's your market trend indicator. Another indicator that we like, I'm a big fan of measured moves. So we have a few different ways to look at measured moves. And one of the things that measured moves do is they provide you with opportunities. And so when the market begins to consolidate, we have what we call a measured move tool. And if you bring this, and so, right, there, you would all agree that this is a pretty sturdy bottom down here, right? And you bring this tool up and you measure the bottom here, and if you take the majority of the candlesticks leading into that area, right, that we'd all agree that that's a trading range, right? Inside of this green box, rather, and you could change the color of this box. But again, as price action is trading in and around that area, you get a breakout. The distance of this box is target 2, and the distance of that box is target 3, and the market moves right up into a second measurement here, and then begins that process of selling off. So if you only want to see one target, you say I only want to look at what one target would look like. It looks like you could change it there. You could change it to 2 targets if you say that's all I want to see, and that gives you targets on either side, right? Market then comes right back up, finds support down here at the bottom of this measured move area again, and then that is how that particular day ended. So again, just a nice simple tool to show you how to measure out particular trading ranges. Because again, what we know is that when they break out of these ranges, the most likely scenario is that you will get a measured move in the direction of the breakout. All right, so one more idea here that I would like to share with you. Actually, I have 2 more ideas. We'll start here with the AB=CD trading tool. And so simply put, what you are looking for is a measured move again. So A to B, right? You find a C point, which in this case is 71%, right? So that's in that fib zone between the 61 and the 79. Market then rallies up, and what you are looking for is a potential short area, right? So A to B, C to D, market comes up into this C to D area, and again, it's supposed to do it in the time, what you would like to see in the ideal perfect pattern, let's put it that way, is you would like to see it measure in the same time and achieve that 100%, or the D, C to D, in the same time frame that it took to do that. This went a little bit longer, but what you want to look for this and use this tool to do is to try to identify areas for the market to pause and turn around. And so again, this would be one idea. You'd be looking for this 2906, and you'd say, well, what else is there up there that would help me make that decision? And then, of course, you have your market structure target, and that would be a really good place to take a look at taking a short. A to B, C to D. If you got in short right here, obviously you could take it down to this next level, and that is 9.25 ES points with virtually no heat against that level. So your A to B=CD tool, let me just show you really quickly how to draw it here. And so what you would do is, let's take this off. All right, and so what you want to do is you want to find the swing spot. You'd come up here to your ABCD tool, turn it on here, and you find a swing low like you did here, and you said, okay, where is it going to retrace back to? And you take it and drag it right up here to the C, right? You drag the C right here to the bottom here, and it'll lay this tool out for you and give you the measurement. And again, with a 2-point stop and a 9.25 point target here to end the day, you would have had a very handsome 4.5-to-1 risk reward trade there. Now, the final thing I want to show you is the OTG price action bars. There's a couple of things that are unique here on the price action bars. One of the things that I want you to notice is that we have a few things identified here. We're going to just turn off the extreme dots, but I want you to look at these dots, right? So these dots represent the 50% of the candlestick, right? So when a bar closes below 50% or above 50%, you can expect certain things to happen. And then when you turn on the extreme dots, which is the top third and the bottom third of the bar, when you get a bar that closes underneath the bottom third, you tend to have a push to the downside. And when a bar closes above the top third, then you tend to have a particular rally. So these are just good reference points for you so that you can see where the top third, bottom third, or the 50% mark is on a particular price bar. Another thing that I like to use these for is I like gap bars. They're called gap bars, and let's see if we could pull this out maybe to a different time frame. This is a 10-minute time frame. Okay. And now we'll leave the dots on for a second. And so what you're looking for is the solid blue bars are down bars and the hollow bars are up bars. And the reason these are called gap bars is because the distance between this bar, sorry, not the distance, but this bar and this bar, right? So the one that brackets the blue bar do not touch one another, right? And so that is considered to be a gap, right? Because these two bars were not touching, right? These two bars do. These 4 bars here all overlap. These bars do not overlap. That is considered to be a gap between these two bars. We highlight that in blue. The reason that's important is because of the old adage that gaps get filled. And what you're going to see from price action is a lot of times you'll have these previous gap bars end up being filled, right? So the market comes down, gives you gap bars, rallies back up, fills that gap before it moves back down again. You get another gap bar here, right? Market comes down, fills this one back up, and didn't quite fill this complete bar up, but it did come back up and close the gap, and not all the way, right? It did at least get into that gap bar again, and that is how that particular day ends. So you could just kind of see that these gap bars tend, and again, you had some gap bars back here, these gap bars tend to get filled. They're just good reference points on your chart to expect price action before it continues in a direction to come back and potentially fill up those bars. So there are a couple of other indicators that are located in the standard indicator bundle. All of those things are located in your OTG membership site. And so that is a quick overview of what's included in your standard indicator bundle.